Hello everyone, myself Suraj Lokhande. This is my consent note. I hereby grant permission to iCapital Academy and Corporate Advisory LLP to use the video presentation, assessment test, and MCQ created or provided by me for educational or promotional purposes. This includes publishing or sharing the content on their social media platforms, website, or through any other medium they deem appropriate. I confirm that I have no objection to such use. So here my topic is about mastering financial modeling. So let's start with our module one, which is Introduction to Financial Modeling. Definitions of financial modeling. Financial modeling is the process of building an abstract representation, a model of a real-world financial situation. These models are used to simulate the impact of various business decisions. They are built using historical data, assumptions, and future projections. So basically, it uses Excel or similar tools to forecast a company's financial performance. Financial models, they are dynamic and can be adjusted as new data or scenario emerges. The next one is our importance in business decision making. Financial model helps estimate the financial outcomes of business decision before implementation. Companies use them for budgeting, valuation, mergers, and acquisitions. Investors rely on models to evaluate the risk and return of investment. So here, for business, financial models are very crucial as they help in decision making for their finance strategy. Companies use like budgeting, valuation, mergers, and acquisitions as they provide a structure framework to support business planning. Areas of application of financial modeling. Financial modeling is widely used in investment banking, equity research, project finance, and corporate development. Startups use models for fundraising and planning, while large companies use them for forecasting and analysis. Private equity firms depend on LBO models to evaluate leveraged buyouts. It also applied in public policy, infrastructure projects, and risk management. So here, LBO model is a financial tool. It used to figure out if buying a company using a debt money will be a good investment or not. So these are the uses of financial model which I pick up. The first one is risk management. Second is valuation of a company. Third is valuation of assets, mergers and acquisitions, option pricing, budgeting and forecasting, capital allocation, and raising funds. Uh, Key components of financial models. The main elements include revenue projection, expense forecast, working capital calculations, and capital expenditure. Models also feature income statements, balance sheet, and cash flow statements. For startup, key components include customer acquisition forecast, pricing models, etc. In project-based modeling, components typically include project timelines, initial capital investment, operating cost forecast, and revenue streams over time. The and here there are other components are like financial ratios, assumption sheets, and scenario analysis. This all ensures that the model reflects real-time financial behavior accurately. And this is the overview of modeling process. The modeling process starts with gathering historical financial data. The assumptions are defined based on trends and expectations. After that, the model is built by projecting financial statements. Linkages are created between income, balance sheet, and cash flows. Finally, the model is tested, refined, and interpreted for decision making. So, in simple words, we can say that financial modeling starts with collecting past financial data. And the next key is assumptions that are made based on trends or goals. When future income, balance sheet, and cash flow are projected. These statements are linked together. Finally, the model is checked, adjusted, and used to support decisions. So here is the short process of modeling. First one is collecting historical data. Then the next step is to make key assumptions. Third one is projection of financial statement. And the last is check and use of model. Types of financial models. First model is discounted cash flow models. Next is leverage buyout models. Evaluate acquisitions using debt. Merger models. Access combined company performance. Budgeting and forecasting models. Each model type serves a unique purpose and user base. So here the DFC model, which calculate the present value of future cash flows, and the budgeting and forecasting model helps in internal planning. And these are all types of financial models. Uh, Three-statement model, discounted cash flow model, merger model, leverage buyout model, initial public offering model, sum of the parts model, consolidation model, budget model, forecasting model, and model of option pricing. So now here's a question. Here's we came to a question, what makes a good financial model? And the answer is a good financial model is clear, consistent, and logically structured. It should be easy to navigate and use proper formatting conventions. All assumptions should be traceable and modifiable. The model should be dynamic and allow scenario testing. Accuracy and error checking are essential features. So basically, a good financial model is clear, consistent, and easy to use with proper formatting. It should be dynamic, accurate, and support scenario testing with traceable assumptions. Users of financial models. The financial models are used by a wide range of professionals. This includes CFOs, financial analysts, investors, bankers, and consultants. Entrepreneurs use them to raise funding or guide strategic decisions. Lenders use them to access credit risk. Each of these users interprets the model to suit their financial decision making. Here's the limitations and challenges. Low accuracy, human error, poor quality of data. Financial models are based on assumptions which will not always be accurate. Poor data quality or unrealistic inputs can lead to misleading outputs. Models may be overly complex or lack flexibility. Human error in formulas and structure can introduce risk. They must be updated regularly to remain useful. So basically, limitations, the challenges are mostly the low accuracy, human error, and there's some poor quality of data. Now here the history and evolution of financial modeling. Early financial modeling was done manually or using basic calculators. With the advent of spreadsheets like Lotus 1, 2, 3, and Excel models became more sophisticated. Today, advanced tools like Python, Power BI, and AI are used. Over time, modeling has become an essential skill for finance professionals. Its scope continues to expand into new industries and applications. So basically, financial modeling started with manual methods like simple calculators. Later, tools like Excel made it easier and more powerful. Now today world in modern tools like Python, AI are used. Now it's a key skill used widely in finance and other industries. Role in strategic planning. Model plays a vital role in long-term business planning. They help simulate various business strategies and forecast their impact. So what are the roles like? The first one is forecasting future performance. Here it helps to predict revenue, cost, and cash flow based on assumptions, aiding long-term planning. The second one is scenario and sensitivity analysis. It tested different strategy, best case, and the worst case scenarios to understand financial impact under various conditions. Third one is resource allocation. It helps in assisting deciding how to allocate capital and resource to the most profitable areas. The next one is investment decision support. It evaluates ROI, RRI, and payback periods to compare strategic investment options. And the last is risk management. It identifies financial risk and builds buffers to handle economic or business shocks. Here, for example, a model can show how launching a new product will affect cash flow and profit. Strategic models aid in capital budgeting and investment decisions. They provide insights into potential risk and returns. The next one is used in performance monitoring. Models can track actual performance against forecast. KPIs like profit margins, ROI, and liquidity ratios are mentioned. Monitored. Dashboards and visual reports make tracking easier. Performance models support continuous business improvement. So this comparison helps manager to understand various variance and take corrective actions. Integration with business plan. Financial models are closely aligned with business plans. They convert qualitative goals into quantitative targets. For example, a growth target is translated into revenue and expense forecast. Models ensure financial feasibility and help secure funding. Investment often demand a strong model to back business projections. So these financial models, they support business plans by turning goals into numbers. Likewise, growth plans become revenue and cost forecasts. This model checks if plans are realistic and help attract investors. So here, this is forecasting versus budgeting. The purpose of the forecasting is to predict future performance as well, and for budgeting, it helps to plan and control future spending. The focus of forecasting is what is likely to happen, while whereas the budgeting, what the company wants to achieve. The time frame of forecasting is ongoing and it has to be updated regularly, example monthly, whereas budgeting typically annually or for a fixed period. Forecasting is based on trends, historical data, market conditions, whereas budgeting it relies on strategic goals, targets, and priorities. The uses of forecasting are for decision making and scenario planning, whereas budgeting, on the other hand, it helps for guiding operations and setting limits. Uh, in short, we can summarize that forecasting is about predicting what is likely to happen in the future based on current trends and past data. It's flexible and often updated regularly. While on the other hand, budgeting is about planning what a company wants to achieve. Usually over a year, it sets fixed financial targets and helps control expenses. Here, the real world use case we can go through. Financial models are used in IPO planning, fundraising, mergers, acquisitions, and capital expenditure analysis. For example, a company like Uber use models to estimate its growth before going public. Real estate firms use models for ROI on property projects. Each case shows us how models guide critical business moves. So the next one is financial modeling versus financial reporting. So let's first go through financial modeling, then we will shift to financial reporting. The financial model, its purpose is to use to forecast financial performance and aid in decision making. Its nature is forward-looking, based on assumptions and scenarios. Users are like internal users are analysts, CFOs, management, investors for projections. It is built and revised as needed, project specific or add HOC. The tools used are Excel, Power BI, Python, financial modeling software. Uh, it is compliant focus are no regulatory requirement, but must be logically and technically sound. Uh, its decision supports helps evaluate mergers, new projects, funding strategy. So basically, financial modeling is forward-looking and helps in forecasting and decision making using assumptions, scenarios, and analytical tools. Now let's go through financial reporting. It is used to present actual financial result of a company. Its nature is historical, based on actual past data. Users are internal and external users. There are both users, investors, auditors, regulators, and management. It is prepared periodically, quarterly, or even annually. Tools are accounting system like SAP with books, Oracle. It must comply with legal and accounting standards. It supports transparency, compliance, and investor communication. So in short, financial reporting is backward-looking, focused on presenting the actual financial performance of a company in a standardized and regulatory compliant format. Here, introduction to Excel for modeling. Excel remains the most used tool for building financial models. Its flexibility, built-in functions, and ease of use make it ideal. Excel can handle large data sets, automate calculations, and produce charts. Many templates are available for beginners. Proficiency in Excel is a must for finance professionals. So, like Excel is the most widely used tool for financial modeling due to its flexibility, built-in functions, and very-to-use interface. It handles large data, calculations, and create visuals. Excel skills are essential for finance professionals. So here's the summary of Model 1. Let's go through what we have learned. Financial modeling is a powerful tool for decision making. It requires strong assumptions, accuracy, and structure. It is widely used across industries for planning, forecasting, and valuation. Excel is the standard platform. Though other exist, a good model tells a story with numbers and supports strategic action. So financial modeling supports strategic decision making through planning, forecasting, and valuation. So now we have come to our next model, which is financial statements. Overview of financial statements. Financial statements are formal records of a company's financial activities. They provide insights into the business performance, financial position, and cash flows. The three primary financial statements are the income statement, balance sheet, and cash flow statement. Together, they help investors and managers make informed decisions. Understanding this statement is fundamental to financial modeling. So, the financial statement shows a company's performance, position, and cash flow. The key statements are income, balance sheet, and cash flow statement, which help in making informed decisions and investment decisions. Let's understand the income statement. The income statement of profit and loss account shows revenue and expenses over a period. It starts with total revenue and subtracts operating expenses, interest, and taxes to arrive at net profit. It helps access profitability and cost management. Key components include gross profit, EBITDA, and net income. So income statement, it is essential for forecasting our future earnings. Now let's understand the balance sheet. A balance sheet shows a company's financial position at a specific point in time. It includes asset, liabilities, and equity. The fundamental equation is asset equal to liabilities plus equity. It reflects the company's solvency, liquidity, and capital structure. So basically, income balance sheet, it helps modelers to track how resources are financed and used in a company. Understanding the cash flow statement. The cash flow statement breaks down cash inflows and outflows into operating, investing, and financing activities. It reconciles net income with actual cash movement. This is crucial for assessing liquidity and financial health. A company can be profitable but still face cash shortage. Modelers use it to project cash needs and debt management. So the cash flow statement, they actually tracks actual cash inflows and outflows from operating, investing, and financing activities. Modelers use it to forecast cash needs, plan debt management, and ensure the business stays financially stable even if profit exists only on paper. Interlinking financial statements. All three statements are interconnected. For example, net income from the income statement flows into retained earnings on the balance sheet. Depreciation affects both the income statement and cash flow statement. Cash changes in the balance sheet are explained in the cash flow statement. So, by proper linking ensures consistency and accuracy in financial models. Working with real company data. Using actual data from public companies improves model realism. Data is taken from annual reports and financial databases. This includes income, balance sheet, and cash flow details. Analysts use Excel to clean and format data. Real data reveals patterns and risks. So by having the real company data, which is actual and accurate, the accuracy of the model is improved. Expense categorization. Expenses are divided into COGS, which is cost of goods sold, operating expenses, and non-operating cost. Understanding fixed versus variable cost helps forecast better. Depreciation, interest, and taxes are also modeled separately. Ensures trends offer insights into efficiency. So by having controlling expenses will directly impact our profit margins. Business expenses. So yeah, business expenses also fall into three areas, which are cost of goods sold, day-to-day operations, and other financial costs. Distinguishing between fixed and variable expenses supports better planning. The next one is our asset classification. Assets are categorized as current or non-current. Current assets include cash, receivables, and inventory. Non-current assets include property, equipment, and intangibles. Modeling includes assets, additions, depreciation, and disposals. Assets turnover ratios help access efficiency. So share assets are split into current like cash and inventory and non-current assets like building and equipment. In models, we track new purchases, depreciation, and when assets are sold. We also use ratios to see how well a business uses its assets. Liability classification. Liabilities are also current, which are due within a year, or non-current. Current liabilities include payables and short-term loans. Long-term debt and lease obligations are non-current. Liability modeling affects interest expenses and cash flow. It also impacts the firm's risk profile. So liabilities indirectly affect the company's interest cost and cash flow. Modeling helps them. to plan repayments and manage financial health. Owner's equity breakdown. Equity includes share capital, retained earnings, and reserves. Retained earnings accumulate from net income after dividends. Equity modeling reflects shareholders' value, important for forecasting return on equity. So modeling equity shows a shareholders' value and help forecast ROE. So as we have come to the summary of this model, so financial statements from the foundation of financial modeling, their interlinkage is vital for building accurate projections, understanding classifications, analysis methods, and real-world example is key. Modelers must ensure consistency and clarity. These concepts are applied in every model that follows. Our next model is types of financial models. Learn key types of financial models used across industries. Each model supports a specific business decision or financial analysis. Core model includes forecasting, valuation, and budgeting tools, crucial for investment banking, corporate finance, and consulting. It helps professionals model realistic financial outcomes and risk. So there are different types of financial model used in various industries. Each one helps with specific decisions like budgeting, forecasting, or valuing a business. These help create realistic financial plans and manage risk. The three statement model. The three statement model, it includes income statement, balance sheet, and cash flow statement used for integrated projections and financial planning. Foundation Foundation for advanced models like DCF and LBO models tracks the flow of assumptions through core financials, common in corporate finance and FP&A teams. This three-statement model connects the income statement, balance sheet, and cash flow. It helps us with the planning and forecasting as it is the base for advanced models like DCF and LBO. It's widely used in corporate finance. Discounted cash flow model. It values a company by forecasting future cash flow. Cash flows are discounted using the weighted average cost of capital, widely used in equity valuation and investment appraisal. It depends heavily on growth margins and discount rate assumptions. Results can vary gently with small changes seen in reports. So basically, discounted cash flow values a business by projecting its future cash flows and discounting them using weighted average cost of capital. It's common in equity analysis, but the outcome depends heavily on assumptions like growth and discount rate. Small changes can lead a big difference in this model. Budgeting and forecasting model. Budgeting and forecasting model, it projects income and expenses to set financial goals, tracks performance against budget and updates regularly, used across departments for financial planning. It includes variance analysis and rolling forecast. These are essential for internal control and management reporting. This model estimates our future income and cost to help set financial targets. By regular updates, it allows team to compare actual results with planned figures. It is widely used for internal budgeting and strategic oversight. The next model is our mergers and acquisition model. This model evaluates the financial impact of a corporate mergers or takeovers, assess synergies, deal structure, and financial implications. It is it is used for accretion, dilution analysis to determine EPS impact, incorporates transaction details, and post-deal integration cost. It supports strategic decision making in mergers and acquisition deals. So here this model analyzes how a mergers or acquisition will affect a company's finances. It includes dilution analysis to see how EPS change. It helps leaders make informed choices in M&A decision making. Initial public offering model supports company valuation and capital raising plans, estimates IPO price, proceeds, and shareholder dilution, benchmarks valuation using peers and multiples, critical for financial advisors and underwriters. So this model helps determine a company value during fundraising or going public. It estimates IPO pricing, total funds raised, and impact on ownership. It is vital for underwriters and financial advisors to guide the offering process. Leverage buyout model. It is used by private equity firms to value acquisitions using debt. It focuses on internal rate of return to equity investors. It includes debt structure, repayment schedule, and exit analysis. It tests how leverage affects returns under different scenarios, popular for strategic buyouts and financial restructuring. In other words, this model helps private equity firms to value their buyouts that uses borrowed funds. It focuses on IRR to equity holders and includes debt repayment plans and exit strategy. Shows how different levels of debt impact investor returns. It is widely used in LBO and restructuring deals. SOTP model or sum of the parts model. It breaks business into segments and value each separately, adds the value of parts to estimate total firm value, useful for conglomerates and diversified business, helps identify undervalued decision on non-core assets. It supports restructuring or spin-off decisions. So basically, this model valuation breaks a company into segments and value each segment individually. It is useful for conglomerates, helping identify hidden value and guiding spin-offs or restructuring decision by showing what each decision is truly worth. Comparable company analysis, CCA. It values a business by comparing with peer companies, uses multiples like EV, EBITDA, PE, or PS ratio. It reflects real market sentiment and trends. It is quick and intuitive valuation methods, often used in investment banking and equity research. So this analysis values a business by comparing it with similar firms using metrics like PE, EV ratios. It's quick, reflects current market trends, and it's widely used in investment banking and equity research. Comparable company analysis. The first one is understanding comparable company analysis. This involves grasping the concept of valuing a business by comparing it with similar companies in the market. It uses financial ratios to assess relative value. The next is selecting comparable companies by choosing peer firms based on similar industries, size, growth rate, and market cata- uh, characteristics for meaningful comparison. Data collection and normalization. It gathers key financial data and adjusts for one-time events or accounting differences to ensure comparability across firms. The fourth one is valuation multiples. It uses multiples like PE, EV, EBITDA, or PS to evaluate how companies are priced relative to their financial metrics. The fifth one is relative valuation. It estimates the targeted company's value by applying the average multiple of peer companies to its own financials. The next is example illustration. It demonstrates the full process using a real or hypothetical case to show practical application of comparable company analysis. The seventh and last one is limitations of CCA. It highlights drawbacks like reliance on market sentiment, data inconsistency, and difficulty in finding truly comparable firms. Precedent transaction analysis. It analyzes analyze sorry, it analyzes past M&A deals to determine valuation benchmarks. It focuses on transaction size, premiums, and multiples. It provides real-world context to support current deal pricing, complements DCF and CCA analysis. It is useful in negotiation and fairness opinions. So this model studies past mergers and acquisition deals to set valuation benchmarks. It helps access fair pricing by analyzing deal premiums and multiples. It adds real-world context and supports negotiation alongside DCF and CCA methods. Conclusion: choosing the right model. Each model serves a distinct decision-making purpose. Selection depends on data availability, business context, and goals. Proficiency in multiple models increase analytical flexibility. Strong modeling skills improve financial planning and strategy. It prepares professionals for real-world financial challenges. So we studied that each financial model has a specific use in depending on the goal and data available. Knowing various models boosts analytical flexibility and strategic planning. Strong modeling skills helps professionals handle real-world finance decisions more effectively. So our next fourth model is building a three-statement model. Introduction to three-statement models. The three-statement models links the income statement, balance sheet, and cash flow statement into one dynamic model. It shows how financial metrics affect one another. This model is crucial for planning and valuation. It provides a complete view of financial performance. It is essential for internal analysis and external reporting. So this model, it helps analyze financial performance, supports planning and valuation, and it is essential for both internal as well as external reporting. So purpose and importance of this three-statement model. It is used in budgeting, forecasting, and decision making. Investors rely on it to test business viability. It helps analyze financial impact of strategies, links assumptions to outcomes across statements, essential for corporate finance professionals. So this model is the key for budgeting, forecasting, and testing new strategies. It links assumptions to result, helping investors and professionals access business financial impact. Components overview includes income statement, profitability, balance sheet, and cash flow statement. Captures operating, investing, and financing aspects. Ensures accurate forecasting, must balance across all statements. It supports scenario and valuation models. So it combines the income statement, balance sheet, and cash flow to reflect profitability, position, and liquidity of a firm. It covers all financial activities to ensure balanced forecast and supports scenario and valuation models. Linking the three statement, net income links income statements and cash flow. Depreciation from income statement is added to cash flow. Ending cash updates balance sheet. Retained earnings links to net income. Ensures all circular references are managed. Here the net income connects the income statement to both the cash flow as well as to the balance sheet. Depreciation is also added back in cash flow. Ending cash updates the balance sheet and retained earnings reflect the net income. Expense forecasting. COGS is often variable with revenue. Operating cost may be fixed or step-based. It includes depreciation, interest, tax forecast. It maintains consistency with historical ratios, flag major cost changes or assumptions. So cost of goods sold usually changes with revenue, while operating cost can be fixed or step-based. It includes key items like depreciation, interest, and taxes. Here, how to use expense forecasting to drive business growth. First one is start with historical data. By Begin by analyzing past expense patterns from previous years. This provides a solid foundation and helps spot trends or recurring costs that influence future projection. The second one is use the right tools. Tools like Excel, budgeting software, or even ERP system to track and project expense accurately. These tools ensures consistency, automation, and reduce human error. The third one is review and adjust regularly. Mhm. By reviewing them monthly or quarterly, adjust them based on changes in business conditions, unexpected cost, or new initiatives. The fourth one is identify areas for cost savings. Find places where you are spending too much and try to save money. This helps improve profits. And the last one is plan for growth. If your business is growing, include new costs like hiring or marketing. This keeps your forecast realistic and help in overall growth. Working capital model. Understand key components. Working capital includes current assets like cash, inventory, receivables, and current liabilities like payables. This model tracks how these items change over time. Use historical averages. Analyze past data to calculate dates for inventory, receivables, and payables. Example DSO, DPO, and DIO. These ratios help estimate future working capital needs. So here the working capital model helps us track current assets and liabilities like inventory, receivables, and payables. We can use past averages to estimate how quickly money moves through this business. It's a key to forecast the operating cycle and link it to cash flow. Seasonal changes and business growth must also be planned as they affect how much working capital is needed. Uh, Forecast operating cycle. Estimate how long it takes to turn inventory into cash. A longer cycle means more funds tied up. Shorter cycle improves liquidity. Link to cash flow model. It connects working capital changes to the cash flow statement. If receivable increase, cash goes down. This helps in planning cash needs. As I earlier said, plan for seasonality and growth. It adjusts the model for seasonal trends or business expansion. Growing companies often need more working capital to support sales growth. All this should be aligned with company's goal. Capital expenditure and depreciation. Capital expenditure is forecasted based on asset needs, depreciation based on historical or asset level schedule. Capital expenditure reduces cash, depreciation affects net income. Track additions, disposal, and book value. It aligns with strategic plans or expansion goals. So capital expenditure is forecasted by looking at future assets, needs like its equipment or facilities. It lowers cash while depreciation is a non-cash expense. It tracks purchases, disposal, and book value. All of these should align with the company's strategic plans or their goals. Debt schedule and interest calculation. Track existing and forecasted loans. Calculate interest based on average debt. Include repayments and new borrowings. Links to financial section of cash flow. Affects net income and ending debt balance. So this debt schedule helps us to track current and future loans in the model. Interest is calculated using average debt over time. It includes both repayments as well as any new borrowings occur. These are linked to the financing section of the cash flow statement. Checks and balances. Use control checks, balance sheet balance, cash reconciliation. Create error flags for missing links. Cross-verify ratios ROE, ROA, or debt equity. It ensures audit trade and formula consistency, increase reliability of the model. Well, this checks and balance, it add control over checks like balance sheet and cash reconciliation to spot any errors. It uses error flags and verify key ratios like ROE and debt equity. It maintains clear formulas to make the model more reliable. Sensitivity analysis. uh, Test impact of changes in the assumption. It uses Excel data for automation, help test best or worst case scenarios, improves decision making, robustness, visualize result with charts. Sensitivity analysis. This model tests how changes in the key assumptions affect our results. It uses tools like Excel to automate the process. This helps explore best and worst case scenarios and improves our decision making process. Charts make the result easier to understand and for visualize. Presentation of model. It creates summary dashboard for users, highlight key metrics like revenue or profit and cash, use conditional formatting for visuals, add documentation and instruction tab, make model user friendly and intuitive. By building summary dashboard to show the key results clearly, highlighting important metrics like revenue, profits, cash flow, by using visuals like conditional formatting for better understanding of the model. Common errors to avoid. Hard coding values within formulas, not linking all statements properly, ignoring balance checks, poorly documented assumptions, over complexity without clarity. By typing numbers directly into formulas makes the model hard to update, not connect, not connecting all financial statements correctly. It can lead to wrong results. Skipping balance checks can miss big errors in the models, making the model too complex. It will confuse the users and increase chances of mistakes. So here's the wrap up of this model. This model build models with structure and consistency, use color coding and templates, Always test and validate the model. Simplify wherever possible. Keep improving with feedback and versioning. By building the model with structure, like by keeping the model organized and consistent, use colors and templates, by making it easier to read and use. Always check if the model works correctly. Keep it very keep it very simple. Don't over complicate the logic. Improve over time by taking the feedback and keeps keep saving updated version. Now let's go to our model 5, which is valuation techniques. Overview of valuation. Valuation determines the worth of an asset or company, used in M&A, investment analysis, fundraising, and IPOs. Its approaches include absolute and relative valuation. Accuracy depends on assumptions and data, crucial for stakeholders making financial decisions. So this valuation helps us to estimate the value of a company. It is key for mergers and acquisitions, investment and IPOs. It uses methods like absolute, for example, DCF, and relative methods like multiple. There can be multiples. Discounted cash flow basis. Discounted cash flow calculates present value of expected future cash flow based on time value of money principal. Key inputs are cash flow projections, discount rate, terminal value. It is used for intrinsic valuation, widely applied in corporate finance. So this model values a business by projecting future cash flows and also discounting them to today's value. It helps access true business worth. DCF key assumptions. They are includes forecast period, growth rate, WACC, and terminal growth. Assumption must reflect realistic expectations. Changes in inputs significantly impact valuation. Transparent documentation is critical. Sensitivity analysis often used to test ranges. As this assumption, this must be realistic and well supported by data. Small changes can greatly affect the final valuation. Weighted average cost of capital. WACC is the discount rate in DCF. It combines cost of equity and debt. It reflects company's risk profile and capital structure. Lower WACC increases valuation. Important to calculate accurately. Well, here WACC, weighted average cost of capital, is the rate used to discount future cash flow in DCF. This represents the company's overall risk and financing mix. The lower WACC means a higher valuation. Terminal value accounts for value beyond forecast period. Methods, Gordon growth model or exist multiple, represent large portion of valuation, sensitive to growth rate and discount rate, common in long-term investment analysis. So this terminal value, it is helps to estimate a company's worth beyond the forecast period. It is calculated using the Gordon growth model or an exit multiple, often makes up a major part of the DCF value. It is highly sensitive to small changes in growth or discount rate. These are essential for capturing long-term value in investment analysis. Comparable company analysis. Relative valuation using peer group multiples. Common multiples are PE, EV, EBITDA, PB. Requires accurate peer selection, quick and market-based method used for benchmarking and pricing. So this comparable company analysis, it helps to value a company by comparing it to similar peers. It uses market-based multiples like PE, EV, etc. It's fast and widely used and reflects current market trends. Precedent transaction analysis. It uses valuation and multiples from past transactions, capture control premiums and synergies, depends on data availability and deal comparability, useful for M&A and exit planning, can overstate value due to strategic pricing. So this analysis looks at past mergers and acquisition deals to estimate its value. It uses deal multiples that often include control premiums and synergies. Sum of the parts valuation. Valuing separate business units individually, used for diversified companies. Each unit valued independently when aggregated, useful for identifying undervalued parts, complex but insightful. As the sum of the parts valuation, it values each business unit separately, then adds them for total value. Helps reveal undervalued segment or hidden assets. Each unit may use a different valuation methods. More, they are more complex but provides deeper strategic insight. Asset-based valuation, based on the net asset value, used for investment companies' liquidation scenarios, may undervalue business with high intangibles, more objective but ignores future potential, common in real estate and holding companies. As this asset-based valuation, it values and calculates a company's worth by subtracting liabilities from total assets. So we get our net asset value, often used for real estate firms, holding companies, or liquidations. It focuses on current assets, not future earnings. So these are in present value, best for asset-heavy industries. Earnings and book value multiples. Valuation based on financial statement figures includes PE, PB, EV, and EBITDA, reflects market sentiment and peer comparison, quick snapshot, less detailed than DCF, used with industry benchmarks. These earnings use ratios like PE and EBITDA for their valuation. They rely on financial statement data and market comparisons. They offer a quick and easy to understand estimate of value. Valuation of startups. Challenging due to limited history and negative cash flow. Use methods like scorecard, risk factor, or VC method. High uncertainty and reliance on assumptions. Important in venture funding. Focus on growth and exit potential. This valuation of startups, it is tough because of limited financial history and often negative cash flows. Common methods include the scorecard, risk factor, and VC method. These rely heavily on assumptions and future potentials. Valuation in M&A context. Buyer focus on synergies, seller on price maximization. Multiples affected by control premium, DCF and precedent transaction often used. Valuation influence negotiation, essential in due diligence. This context consider both the buyer as well as the seller's synergies and price expectations. Common methods include DCF and precedent transaction analysis. Valuation plays a key role in negotiations. Valuation adjustment and normalization. Adjust financials to reflect true earnings. exclude non-recurring items or owner's expenses, important for comparability used in private company valuation, improves transparency. This valuation adjustment and normalization, it refines a business financial to show the company's true earnings capacity. They remove one-time cost, usual income, or even personal expenses, essential for comparing companies fairly, especially private firms. Valuation using Excel. Excel supports model creation, automation, and scenario testing. Templates available for DCF and multiples. Use of functions like NPV, IRR, XMPV. Macros can streamline sensitivity analysis, ensures model flexibility. By using Excel for valuation, it allows building flexible and dynamic financial models. It supports DCF multiples and scenario testing with built-in functions like NPV, IRR, and XMPV. Macros help automate sensitivity analysis. Evaluation using Python or R. Advanced user built models using pandas, NumPy, and Matplotlib. Sorry, Matplotlib automate large data sets and backtest, useful in fintech and analytics, customizable and scalable, growing popularity in investment firms. By using Python or R, it is ideal for handling complex or large-scale financial analysis. Libraries like Pandas, NumPy, etc. help build and visualize models. It is great for it is great for automating workflow and running backtest. It is preferred in fintech and data-driven firms only, gaining popularity in modern investment analysis. Valuation reporting and communication. It summarizes assumptions, methodology, and results, uses visuals like charts and tables, keeps explanation clear and concise, tailor presentation to audience, builds confidence and support decision. By using this method, it involves clearly presenting your methods, assumptions, and conclusions. It uses charts, tables, and visuals to make complex data easy to understand. Keep your explanation concise and audience friendly. Common valuation mistakes. Overly optimistic projections, wrong discount rate or terminal assumptions, ignoring working capital needs, poor peer selection, lack of sensitivity testing. By selecting wrong discount rates, ignoring working capital and poor peer needs, not testing key inputs are some common mistakes of valuation. Sensitivity and scenario analysis. Test impact of changing inputs, scenario change multiple assumptions, sensitivity vary one input at a time, visualize with tornado charts, highlights key type drivers. This tool tests how your model reacts to change in inputs. Scenario analysis changes several assumptions at once to reflect situation like best or worst case. Sensitivity analysis varies one factor at a time to see its effect. Valuation in real world cases. So here, where are the valuations are used in the real world? It is used in IPO pricing, mergers and acquisition M&A firms, fundraising, litigations. Each cases requires unique adjustment. Combining methods improves reliability. Subjectivity exists, but discipline helps. Documentation critical. As so, in short, valuation is used in IPOs, mergers, funding, and legal cases. Each situation needs specific adjustment. Using multiple methods gives better results. So our next model is scenario analysis and forecasting. Introduction to scenario analysis. Scenario analysis helps in evaluating different future business environments. It involves creating best case, worst case scenarios, and base case projections. This technique helps assess risk and prepare for uncertainty. Often used in budgeting, forecasting, and strategic planning, it supports better decision making by showing a range of outcomes. So the scenario analysis models, it provides the best case, worst case situation to explore different possibilities for a business. It identifies how changes in assumptions can affect the results, commonly applied in budgeting, forecasting, and strategic decision making process. Importance of forecasting in finance. Forecasting predicts future financial outcomes using historical data and trends. It's essential for planning revenue, cost, and profits. Accurate forecast guides budgeting, investment, and risk management. Financial forecasting also aligns departments towards common goals. It builds financial discipline and accountability. This forecasting in finance, it uses past data and trends to estimate revenue, expenses, and profits. It helps in preparing budgets, investment plans, and funding needs. It encourages accountability by setting clear financial targets and expectations. Key types of forecasting models. So here are some of the forecasting models. Common forecasting models includes time series, regression, and moving averages. Time series uses past trends to predict future values. Regression links financial drivers to outcomes. Moving averages smooth out fluctuations. Choosing the right model depends on data and purpose. Each type support different forecasting needs. So the time series forecasting. This uses historical patterns to project future results, and the regression analysis, it links input factors like sales drivers to outcomes greater for understanding relationship, uh, whereas moving average, it smooth out function to show trends more clearly over time. The best model depends on your data type and the company's forecasting goals. Scenario planning framework. A good scenario planning framework includes identifying key drivers, building assumptions, and creating models. Scenarios should be realistic and stress tested. Assign probabilities or weights to each scenario. Compare results to the base case. This helps companies adapt quickly to changing environment. By identifying key drivers, it helps to focus on factors that influence financial outcomes, example, demand, cost, and regulations. Create scenario models, reflect how each scenario impacts financial statements. Uh, uh, Reflect how each scenario impacts financial statements. By enabling adaptability, it helps business prepare and respond to uncertain futures effectively. Creating assumptions for scenario. Start by identifying clear data-backed assumptions for each scenario. Consider economic factors, business cycles, and internal drivers. Use consistent methods across scenarios. Enable assumptions clearly in your model. This ensures transparency and improves trust in the forecast. Make sure by making sure each scenario is based on real factors and data. Thinking about big factors, it includes things like economy, market trends, and company plans. keeping it the same by using the same method for all scenarios. Label everything by clearly name and organizing all inputs in the model. Our seventh one is our next one is advanced modeling technique. Overview of advanced modeling. Advanced modeling enhances realism and decision making with complex logic and automation. It bridges finance theory with real world application and is essential for robust financial planning. It supports dynamic analysis, allow users to test multiple scenarios. It uses tools like macros, Power Query, and advanced Excel functions to reduce manual work and improve model accuracy. So, in short, it connects the financial theory to the real world business applications and decision making. It helps plan more accurately with detailed forecasting, allows testing multiple scenarios and outcomes at the same time. Dynamic formula design. Here are just the simple and short formulas which I pick up. First one is use index match, offset, and indirect, and nested IFS for flexible, scalable models. These tools allow dynamic referencing and reduce manual updates, improving automation and model integrity. So by using this formula, this helps to update automatically when data changes. In short, they are linked with each other. It reduces manual work and keeps the model accurate and easy to manage. Data tables for sensitivity analysis. One and two variable data tables test outputs against changing inputs. They are essential for analyzing metrics like NPV or IRR under different assumptions, and it enhances decision-making confidence. This data table let you see uh, how changes in inputs affects results like NPV or IRR. It uses one and two variable data tables, which help to test different scenarios. They are easy to build in Excel and saves a lot of time. Goal seek and solver. Goal seek back calculates inputs to reach a desired result. Solver optimizes multiple variables with constants. They are used in break-even analysis and financial optimization models. Well, goal seek helps to find the input needed to reach a specific result, like break-even sales. And on this other hand, the solver, it adjusts multiple inputs to find the best outcome under certain limits. Both are powerful Excel tools for financial planning and optimization. If and or choose functions. Logic functions add flexibility and simulate real-world decision. They are commonly used in pricing, revenue, and tax scenarios to apply business rules in Excel models. These four are the functions of an advanced Excel which we use in financial modeling. Array formulas and dynamic arrays. Formulas perform complex calculation across ranges. Excel's new dynamic arrays like filter, sort, and unique simplify large data sets and boost automation. These array formulas, it helps let you do advanced calculations across many cells at once. They help automate tasks and save time in financial modeling. Macros and VBA for modeling. Macros automate repetitive tasks. VBA customizes models for importing data, generating reports, or running simulations. Proper error handling and documentation are vital. VBA enhances Excel capabilities by allowing user-defined functions and interactive dashboards. These macros, they saves time by automating routines, tasks in financial modeling, whereas VBA, on the other hand, they adds powerful customization like importing data or creating simulations. Modeling with Power Query. Power Query, Power Query cleans and structures raw data from multiple sources. It supports automated refreshes and reduce errors in data-heavy workflows, ideal for advanced modeling tasks. Power Query supports merging and transforming data from various files, databases, or web sources into a clean analysis-ready format. Mm. It helps create repeatable data workflows, saving time and ensuring consistency in financial models. These Power Queries, it helps to clean and transform raw data from different sources. It enables automated updates, reducing manual effort and errors. It is ideal for large recurring data tasks, ensuring models are consistent, clean, and reliable. Pivot tables and Power Pivot. Pivot tables summarize large data quickly. Power Pivot support data relationships and DX measures. Both help build interactive dashboards and perform multi-dimensional analysis. This pivot table, it helps to summarize and analyze large dataset instantly. Both these tools are essential for creating interactive dashboards and performing deep multi-dimensional analysis in financial models. Building interactive dashboards. Dashboard presents KPIs and visuals for analysis. Use slicer, charts, and conditional formatting for dynamic tracking. Dashboard simplifies stakeholders reporting and performance monitoring. These interactive dashboards are a powerful way to present key financials and operational data. They use tools like slicer, charts, and conditional formatting to make data more engaging and easier to understand. Dashboards help stakeholders monitor performance in real time and enable smarter decisions. Common multiple data sources into single view, offering a comprehensive pictures of business, ongoing tracking of metrics like revenue, cash flow, or ROI helps business adjust strategy effectively. Rolling forecast model. Rolling forecast maintain a 12-month forward view, updated monthly or quarterly. They support eligibility in planning and are preferred in FP&A over static annual budgets. They support strategic decision. Regular updates ensure forecast reflect the latest data, which supports better decision making by leadership. This rolling model are dynamic planning tools that give us a 12-month or longer outlook. They are updated regularly. Unlike the static budgets, they help business stay flexible and responsive to change. Cohort analysis in financial models. Cohort analysis groups customers by similar traits to study behavior over time. It's used in SaaS, e-commerce, and subscription models to analyze retention and customer lifetime value. Supports targeted decision making. It allows businesses to focus on the most profitable or loyal customer groups. It improves forecast accuracy. Insights from cohort trends helps define revenue projections and marketing strategies. This cohort analysis tracks customer groups over time to study retention and value. It helps to improve forecast and lets business focus on high value, loyal customers, especially in SaaS and e-commerce. Waterfall charts and bridge analysis. These visuals show how components contribute to a total change. like budget variance. They are effective for earnings or cost analysis and commonly used in board reports. Waterfall charts help explain how starting figures, example revenue, reach and ending value, example net income, making financial narratives easy to follow. Easily created in Excel or BI tools, they can be linked to financial models for a real-time updates as assumptions or value changes. The waterfall charts, they are visually explain how value changes step by step from start to end, like from revenue to net income. They are useful for showing variances, easy to build in Excel, and help simplify financial reporting. This is the example of the waterfall chart. Circular references and iterative calculations. Circular references arise when formulas loop back. Some models need them. Example, date interest loops. Excel allows iterations but needs careful testing and documentation. In Excel, iterative calculations must be enabled manually. Set a limit on iterations and acceptable change to avoid endless loops or incorrect results. Circular references are often used in models with interest or date, cash sweeps, or tax shield, where output affects the input repeatedly. This circular reference happens when formula refer back to themselves, often used in date interest or tax models. Excel allow these loops to interactive calculations, but these must be handled carefully with proper limits and clear documentation to avoid any errors. Best practice for model documentation includes notes on inputs, assumption logics, and outputs. Use a dedicated documentation tab and version tracking. This enhances collaboration, auditing, and model longevity. Use consistent naming for sheets, ranges, and cells to improve clarity. Color code input, output, and calculation cells for easy navigation and understanding. These practices added notes for inputs, logic, and outputs. It uses a separate tab for documentation and track versions. It names sheets and cells clearly. Use color coding to highlight any inputs, outputs, and formulas. These are the practices for a perfect model documentation. Model testing and validation. Test models with extreme rules, audit formulas, and reconcile with external data. Add checks and error flags to catch mistakes early. Validation ensures reliability. Test how changes in key assumptions, example growth rate, interest rate, impact outputs to understand model behavior and robustness. Run best case, and worst case scenarios to ensure the model performs correctly under different conditions. Trying extreme inputs, this test the model with very high or low values to see if it still works properly. Check formulas and data by making sure all the formulas are correct and match actual financial data. Using error flags, add alerts or checks to catch mistakes early, like missing links or mismatched tools. By running different analysis, running different scenarios, by trying out the best case, worst case, and unexpected case plans to prepare for the future. Integrating Excel with external data. Connects Excel to databases, APIs, or cloud platforms for real-time data. It improves automation but needs secure access and proper integration to prevent errors. It helps us to save a lot of time and reduce chances of human error. Poor integration can lead to wrong numbers or even broken models. Using Python and R in modeling. Python and R support advanced analytics tools like Pandas and NumPy, enable data analysis, while Excel integration allows automation ideal for data-heavy or statistical models. Advanced analytics, Python and R handle large datasets and complex analysis better than Excel. Statistical modeling, great for regression, forecasting, and machine learning in finance. By using Python and R in modeling, they are very powerful tools for doing any heavy financial modeling task. They offer speed, automation, and even advanced analytics, ideal for modern financial professionals. AI and machine learning in financial modeling. AI models forecast trends and detects anomalies used for fraud detection, credit scoring, and pricing. Integration with Excel or cloud platforms is growing in popularity. Predictive power. AI/ML algorithms help forecast sales, cost, and market trends with high accuracy. Excel and cloud integration. Tools like Power BI, Python, and APIs bring AI into Excel models and dashboards. Self-learning capabilities. ML models improve over time, reducing human effort in forecasting and analysis. By using AI and machine learning, it enhances financial modeling by improving forecasting, detecting fraud early, and automating any decision making. Their integration with Excel and cloud tools is making models smarter and more efficient. Model recap. Reviewed all key tools, covered macros, dashboard, Power Query, VBA data, tables, and scenario analysis. Integrated techniques. Learned how to combine tools like Solver, GoalSeek, and dynamic formulas for powerful models. Focus on automation, emphasized reducing manual work using advanced Excel features and scripting. Final application. Capstone task involves building a full model with automation, scenario testing, and reporting features. In this model, we have reviewed that the key advanced tools like macros, Power, Query, and dashboards. Techniques like Solver, GoalSeek were integrated to build dynamic models. It was on automation and reducing manual work. So we have come to our next model, which is industry-specific modeling. Industry-specific modeling, tailored financial models for different industries, focus on sector-specific metrics and drivers, helps in accurate forecasting and valuation, common in banking, real estate, SaaS, and manufacturing. These industry-specific models, they are designed with sector-focused metrics and key drivers. They improve accuracy in forecasting and valuation. Common sectors include like banking, real estate, SaaS, and manufacturing. It requires understanding of industry norms, supports better strategic decision making, data sources, and KPIs vary across sectors. Real estate financial modeling. It focuses on property, cash flows, and IRR. It includes rent rolls, vacancy rates, cap rates, model account for loan amortization, and leverage used by REITs and property developers. Here, the key elements are rent rolls, vacancy rates, and capitalization rates. It is commonly used by REITs, investors, and developers for feasibility studies. It calculates NPV of future rents to value property. It is important for project feasibility and valuation. NPV of rental income is commonly calculated. As I said earlier, uh, scenario analysis helps with market risk. Banking and financial institutions models interest income, loan losses, capital adequacy, key ratios, NIM, NPA, CAR, ROA, and ROE. Stress testing and Basel norms integration includes regulatory and compliance cost. Loan book projections are essential, used for budgeting and performance tracking. Interest rate risk is a critical component. These banking and financial institutions, they focuses on interest income, loan defaults, and capital adequacy requirements. They tracks key ratios like NIM, which is net interest margin, NPA, which is non-performing assets, CAR, capital adequacy ratio, ROA, and ROE. It includes regulatory frameworks such as Basel norms and compliance cost used for internal budgeting and regulatory reporting. Interest rate fluctuation play a key role in model assumptions. SaaS and subscription-based models tracks MRR, ARR, churn rate, CAC, and LTV. Forecast based on customer cohorts and plans. Revenue recognition follows deferred income. Customer acquisition and retention are critical. Growth metrics guides investor decisions used for fundraising and IPO planning. Frequent use of cohort and funnel analysis. Well, this SaaS model, it focuses on key metrics like MRR, monthly recurring revenue, ARR, annually recurring revenue. It focuses on models emphasizes customer acquisition and retention strategies. Common tools include cohort analysis and sales funnel modeling, helps in evaluating scalability and long-term profitability. Manufacturing industry models includes production capacity, COGS, and inventory. Models capex, working capital, and fixed assets. Key metrics, utilization rate, break-even point. Supply chain cost modeling included. Depreciation and cost variance monitored. Supports pricing efficiency and budgeting. Labor and overhead cost forecast crucial. So it focuses on production capacity, cost of goods sold, and inventory levels to track efficiency. It includes capital expenditure, fixed asset planning, and working capital needs. Models include supply chain and logistic costs to evaluate profitability. Depreciation, raw material prices, and cost variance are regularly monitored. It is used for pricing decision, budgeting, and operational planning. Oil, gas, and energy sectors models. Capital-intensive long-term investment focus, key metrics BOE, break-even cost, IRR, NPV. Revenue projection from commodity prices. Models include depletion and capex cycles used in asset valuation and M&A deals. Scenario includes geopolitical risk pricing. Environmental costs are now frequently modeled. So these oil, gas, and energy models, these are mainly focus on long-term capital-heavy projects like drilling or energy plants. Their key metrics include BOE, which is barrel of oil equivalent, break-even cost, IRR, and NPV. Its revenue focused depend heavily on fluctuating commodity prices, includes modeling for resource depletion, production decline curves, and capex plan. Telecom sector financial modeling, revenue driven revenue driven by ARPU, subscriber base, capex heavy models with infrastructure investment, tracks churn, spectrum cost, and tower lease. These models are based on average revenue per user and subscriber based. They are very heavy investment in network infrastructure and spectrum. Digital KPIs includes metrics like data usage, 5G rollout, and digital engagement. Include licensing and regulatory fees used in valuation and investor reporting. Project financing and ROI are crucial aspects. Digital formation KPI integrated recently, like for example 5G rollout, which is recently happening. Healthcare and pharma modeling. It involves R&D expenses, forecasting, and approval cycles. Revenue depends on patents, drugs pipeline, track cost of trials, and launch timelines. Valuation includes probability weighted scenarios, highly compliance and regulatory cost impact, licensing deals, and royalty streams modeled. This model includes research and development cost and long approval timelines. These are revenue drivers based on patient, patent lifecycle, drug pipeline, and product launches. Clinical trials and timelines. Tracks trial phases, cost, and expected launch dates. Licensing and royalties. Includes models for licensing income and royalty payment from partnership. E-commerce business model. Track GMV, net revenue, fulfillment cost. Customer acquisition and repeat rates critical. Model return, logistic and platform fees. Frequent use of dynamic cohort modeling. Valuation often based on revenue multiples. Marketing ROI and conversion rates important. Use dashboards to track metrics in real time. These are focuses on gross merchandise value, GMV, net revenue, and fulfillment cost. They track acquisition cost, revenue, repeat purchase rate, and customer lifetime value by seeing and organizing customer behavior. Operational cost includes model returns, delivery charges, and platform commission fees. They use dashboards in real time to monitor business health and performance metrics. Recap. Each industry has unique drivers and metrics. Model must be adapted to regulatory environment. Choosing the right KPIs improves relevance. Understanding business model is essential. So the tailored approach is that each industry requires a model customized to its own drivers, structured and KPIs. Financial model must reflect the legal and compliance environment of the sector. The KPI matters. Using industry-specific metrics improves model insights and decision-making quality. The strategic alignment are to enable better financial planning, control, and long-term strategic decision. Industry models improve accuracy of projection. Customization is the key to stakeholder trust, supports targeted financial strategy and control. By using industry-specific, improves model insight and decision-making quality. By enabling better financial planning, control for strategic decisions. So our next model is of ethics governance modeling. Introduction to ethics in financial modeling. Ethics ensures integrity and transparency in models. Improve modeling can lead to poor decision and financial loss. Ethical standard builds stakeholder trust. Modelers must avoid intentional data manipulation. Honesty and accuracy are core principles. Ethics guide responsible financial planning. Conflicts of interest must be dissolved. So, in short, we can summarize it by ethics in financial modeling ensures honesty, transparency, and responsible in decision making. It prevents manipulation of data and prevents trust and builds trust of stakeholders. Common ethical issues are manipulating assumptions for favorable outcomes, hiding critical data or risk, leveraging of other analyst work, failing to disclose context of test. Some common wrong practices in financial modeling, changing numbers to make the results look better, financial cheating, hiding important information, copying others. Governance in modeling. Governance ensures proper oversight of models, define responsibilities and accountability. It involves governance. Here, the governance in modeling means setting these responsibilities to make sure models are used properly. It includes who approves, conversions, and follows standards. This helps reduce errors, ensures quality, and keeps models aligned with business and legal requirements. Model audit trails. Audit trails document changes in the model, enable tracing of inputs, formulas, and logic changes, improves accountability and transparency, helps auditors understand model evolution, supports model validation and debugging, critical in regulated industries, facilitates internal and external reviews. Model audits are record that shows what changes were made to a model when and by whom. They help track updates to inputs, formulas, and logic. This makes the model more transparent and easier to review, especially during audits. Internal controls in modeling. Control prevents errors and frauds. Example include locked cells, password protection, segregation of duties, improves model integrity. Automated checks improve reliability. Version history prevents unauthorized changes. Data validation ensures accurate inputs, reduce financial and reputational risk. So control in modeling helps prevent mistakes and fraud. These include locked cells, password, and input checks. They ensure data accuracy, protected model integrity, and reduce financial risk. Documentation standard. Well-documented models are easier to review, include details on assumptions, source, logic, use dedicated documentation sheets, enable version history and change logs, help new users understand the model, supports audits and governance reviews. It improves collaboration across teams. By having a good documentation makes model easier to understand, use and review for others. It includes assumptions, formulas and data sources. Clear records helps with audits, updates and teamwork. Auditing techniques, formula tracing and logic review, recalculating results manually, input-output consistency checks, stress testing model performance, cross-verifying with external sources, documentation and validation testing, error flagging for unusual outputs. Audit testing ensures your model is accurate and trustworthy. Uh, it includes tracing formulas, checking logic, testing with extreme values, and verifying results with reliable data sources. Model risk management. Identify and assess potential risk in models. Mitigate risk through validation and peer reviews. Define escalation protocols for failures. Maintain backup version of key models. Perform scenario testing for robustness. Risk management aligns with business continuity. Promotes resilience in planning and reporting. This model risk management is all about spotting and reducing errors in failures in financial models. It includes testing, reviews, and having backups. This ensures models are reliable even during unexpected situations. Ethical decision-making framework. Identify the ethical dilemma clearly. Consider consequences of decisions. Consult guidelines and codes of conduct. Evaluate all alternatives objectively. Decide and act in good faith. Review and learn from the outcome. Promotes responsible professional behavior. Well, and ethical decision making helps professionals handle dilemmas responsibly. It involves identifying the issue, considering consequences, and following ethical guidelines. The goal is to make fair and honest choices. Data confidentiality and security. Secure sensitive data with encryption, restrict access to unauthorized users, use secure platforms for data exchange, avoid using personal devices for client data, audit log tracks, access and changes, compliance with data protection laws, build trust with stakeholders. So the data confidentiality means keeping financial information safe and private. It involves limiting access, using secure tools, and following data protection laws. These steps prevent misuse and build trust. Version control and governance tools. Use naming conventions for clarity, maintain change logs and approvals, leverages tools like Git or SharePoint, track edits with version history, supports collaborative development, prevents unauthorized changes, improves traceability and reliability. Where here version control helps track changes in financial models. These tools like SharePoint or Git record edits, approvals, and prevent unauthorized updates. This improves teamwork, reliability, and traceability. Ethics in automated models ensures algorithms do not discriminate, disclose model assumptions transparently, avoid bias in training data, validate automated outputs regularly, maintain documentation, use human oversight where needed, follow AI governance guidelines. Where when using any automated models, we must ensure fairness and avoid bias. Clear documentation and regular checks help maintain transparency, while human review keeps decision ethical and accountable. Bias in financial modeling. Bias gives model accuracy and fairness. Types include confirmation, recency, optimism, avoid cherry picking data, use neutral assumptions and inputs. Peer review helps identify hidden bias, maintain transparency in assumptions. Bias impacts decision making quality. Uh, Bias in financial modeling, it affects fairness and accuracy of the data. Common types include optimism and confirmation bias. Using neutral imports and peer reviews helps reduce bias. Transparency is the key to trustworthy result. Regulations and compliance. Follow local and global accounting standards. Comply with data privacy laws, example GDPR. Understand industry-specific regulations. Model used in reporting must meet audit norms. Penalty exists for non-compliance. Maintain evidence of compliance steps. Supports regulatory reporting with clear models. The regulations ensures models follow accounting and legal standards. Compliance with standards like GDPR and audit norms is essential. Non-compliance can lead to penalties. Always keep records of your compliance process. Model validation process. Independent verification of model logic. Check for alignment with business rules. Validate against historical results. Peer review and audit checks. stress test under various scenarios, document validation findings, ensure model readiness for use. This model validation ensures accuracy and reliability. It involves logic checks, peer reviews, and stress testing to confirm the model behaves as expected. Documenting the process is the key to accountability and audit readiness. The roles of ethics committee establish company ethical standards, oversee review provide ethical training and resource, handle ethical breach complaints, advise management on gray areas, ensure ethics stay central to modeling. And ethic committee here plays a key role in promoting responsible modeling. It sets standards, reviews critical models, and offers trainings too. It also handles ethical concerns and ensures integrity stays at the heart of the financial practices. Building a culture of ethics, promote integrated across all finance teams, lead by example through ethical leadership, reward ethical behavior and transparency, encourage open discussions on dilemmas, provide access to ethics resources, foster accountability and responsibility, embedded ethics in training and onboarding. Encouraging ethics in finance involves strong leadership and clear values. Teams should be there should be teams who will be trained, supported, and rewarded for honest behavior. Open communication and accountability build a culture of trust. Training and capacity building. Regular workshops on ethics and governance. Train on tools for model validation and audit. Use real case studies for practical learning. Encourages the cross-functional learning. Certification boosts credibility and awareness. Mentorship promotes knowledge sharing. Support a continuous learning mindset. By doing regular training, building ethical awareness and technical skills, case studies and certification helps apply learning practically. Cross-functional mentorship encourages ongoing improvement and stronger modeling culture. So here's the wrap up and key takeaways of this model. Ethics and governance are core to financial modeling. Good documentation enhances reliability. Validation ensures model accuracy. Internal controls mitigate risk. Transparency builds stakeholder trust. Stay updated on best practices. Make ethics part of daily modeling work. So, to wrap up this, ethics and governance are essential for reliable financing. Models, proper documentation, validation, and controls reduce errors and risk. Transparent practices strengthen trust and support responsible decision making.